I want to talk about interest rates a little bit. I mentioned that a lot of the macro people I have on this podcast lately have really been discussing that the Fed is no longer the focus. I've already mentioned that. They're saying if they cut once or twice in the next 3 to 6 months, it doesn't really change much of anything. What is your outlook for interest rates for the remainder of this year?
So I think that the Fed is going to have trouble cutting interest rates at the next two meetings. I wouldn't say it's impossible, but they started meeting late July. Unless we get really weak economic data, which is possible, the Fed might not want to cut. Now, if we get a really weak employment report, if the inflation numbers and consumer spending numbers continue to come down, it's possible we could get a Fed cut at the end of July. The September meeting is tricky because it's in the heart of the election campaign. The Fed probably doesn't want to be seen as moving policy unless it really has to and has no other choice. So that kind of leaves the next meeting on November 7, which is 2 days after the elections here in the U.S., is sort of their next real option to move policy if they don't do it in July or September. My view of the Fed sort of more generally is the Fed tends to keep interest rates low for too long and then panics and raises them. And then they tend to keep rates high for too long and then panics and cuts them. So my guess would be the Fed stays higher for longer but then cuts way, way more than the forward curve currently suggests. The forward curve currently says the Fed eventually brings rates down to 4%. I wouldn't be surprised if eventually, if we have a recession next year, they go to 3, 2, maybe even 1% rates, in which case, and again, this is not a forecast, it's just a possibility for what could potentially happen. And if that were to happen, you would have a potentially huge steepening of the yield curve, potentially a huge rally in precious metals, especially gold, but maybe silver as well. And then also potentially really big gains in small cap stocks relative to large caps.
Couple questions off of that. First off, do you believe that where we are right now with 5%, 5.25% rates, is that really too high?
Well, I think it may be too high. I mean, one indicator that it's too high is that the yield curve is really, really sharply inverted. Normally the yield curve has a positive slope. So normally short-term interest rates are lower than long-term interest rates. We've had the opposite of that now for the past 2 years. There's a lot of people who are saying, well, this time is different, because the inverted yield curve reflects lower inflation expectations, which could be true, could also reflect falling, inflation expectations. But generally speaking, when we've had yield curve inversions in the past, that has been followed by economic downturns with usually a lag of about 2 years. And that's the really tough part for the Fed, for investors, for economists. 2 years is a long time. So you can have an inverted yield curve for 2 years and the economy continues to grow. But it's only later on that the downturn hits. And what makes me really worried is when I look into the economic data, I look at things like the household survey, which shows rising unemployment, which shows we've lost 1 million jobs since late November. You look at weaker consumer spending. You look at some of these surveys like the ISM surveys, employment components, which show potential net job losses coming in the next few months. And I'm really concerned, the Fed may have over-tightened policy and may be keeping rates too high for too long. Now, that's not proof that things are going to go wrong. We'll have to wait and see, but that's my concern.
And going back to where you said the Fed will stay higher for too long, just like they stayed lower for too long. The question I have about this current market environment is that if they were to go back to cutting and taking us too low too quickly, wouldn't that create inflation again? Wouldn't we almost set that situation right back up to where we are now because rates were too low for too long? So I guess a lot of people that I talk with say that the Fed is most likely just to really do really little to nothing. But if what you're saying starts to happen, boy, that just gets really interesting, I guess, because I guess it would come down to the reason as to why they're cutting too, right, Eric?
Yeah, that's right. And so, that's why I really think it's unlikely that the Fed goes back to, say, zero rates. So if you look at the last couple of recessions, the one we had in 1990-91, the one in 2001, the one in the global financial crisis around 2008, and also the sort of artificially induced pandemic recession. Well, during the first 3 of those recessions, the Fed cut interest rates by 500 basis points or more. They obviously couldn't do that at the beginning of the pandemic because rates were only 2 3/8% to begin with. But they did cut rates down to zero the last 2 times. And the previous time during the tech wreck, they cut rates from 6.5% to 1%. I don't think they're likely to move policy that low because just for the reason you stated, inflation is not normalized all the way back to 2%. It's still running at 2.6% on the core PCE, still 3.5% on CPI. But I think that there would be potentially people who would look at that and say, well, you know what, the only inflation that we have that's running above average is rental costs for housing. If you exclude rental costs for housing, we're actually below 2% inflation. And so the Fed's interest rate policy doesn't really influence rental costs very much because rental costs are being driven by really low vacancy rates, which are in turn being driven by very, very low levels of construction, and construction itself is being impeded by high rates. So, I think that there is a case there that the Fed could ease policy, not as dramatically as it has during some of our recent recessions over the last, say, 30 or 40 years, but still cut rates more than what the forward curve currently suggests, which is really not very much.